On behalf of Forvis Mazars and the ESOP team, I'd like to welcome everyone to today's webinar, ESOPs Continuing a Legacy. As you may be aware, this year we officially launched a new global professional services network, Forvis Mazars. We are ranked among the largest public accounting firms in the United States and are committed to providing an unmatched client experience with our assurance, tax, and consulting services. Please visit us at forvismazars.us to learn more. Now, let me introduce today's presenters, Kara Benningfield and Angela Fisher.
Good afternoon, everyone. I'm Kara Benningfield, and I am a partner at Forvis Mazars. I'll lead the firm's national ESOP consulting practice and have been working with employee-owned companies for over 20 years.
And my name is Angela Fisher, and I'm a director in our ESOP Transaction Services group as well, and I'm located in Kansas City, Missouri. I work alongside Kara in structuring the new ESOP transactions as well as assisting existing ESOPs with ongoing consulting like record keeping, sustainability planning, and other topics that mature ESOPs may face.
And we are so excited to have you guys here today. We're going to cover a few key items. We're going to talk about what an ESOP is, how it works. We'll talk about the benefits of an ESOP. We'll dig deeper into ESOP plan design. We'll think about reasons why an ESOP might be a good fit for your company and some reasons why ESOP might not be a great fit. And then we'll wrap up with hopefully a few moments for questions. So at Forvis Mazars, we serve over 400 ESOPs all around the country. Those are companies in many different industries, whether that be manufacturing, distribution, construction, seeing a lot of activity in the construction space, also professional services, lots of activity. And so our job is really to help educate owners as to whether ESOP could be a good fit, help them understand the benefits, and also think about risks and how we manage those risks. And in the end, really there to be a trusted advisor as people consider an ESOP for their particular company. One of the biggest reasons why people choose an ESOP as opposed to some other type of strategy is because they are looking to, preserve legacy, to take care of culture. Many times it's important to that owner to take care of the community, to reward the management team, as well as the rank and file employees. We'll also talk today about income tax benefits. We'll talk about some ways to reward the key management team. And many of our ESOP companies use the ESOP as a platform to grow their company, to help execute acquisitions, and ultimately to grow in a way that perhaps they couldn't if they had another corporate or tax structure. So what is an ESOP? An ESOP is a type of qualified retirement plan. It is similar to a profit sharing plan. It has a lot of the same rules and regulations, but the difference is that the ESOP is designed to invest primarily in the stock of the sponsor company. And it is unique in that it can borrow money to purchase that stock, and we call that a leveraged ESOP. In the ESOP trust, the trust or the retirement plan is actually the legal shareholder. Employees don't own shares individually like you might own shares of your company today. So those employees are receiving value through their retirement plan, but they never actually receive shares of stock, which is an important distinction. ESOPs are governed by the Internal Revenue Code, by ERISA, which means that they're overseen by the IRS and the Department of Labor. So let's talk about some ESOP statistics. There are over 6,500 ESOPs all around the country. They cover over 14 million employees, and most of those ESOPs are sponsored by privately held companies. If you go back to 1998, there were less than 100% ESOP-owned companies, where today there are about 2,500. And there have been a lot of studies that show that ESOP-owned companies outperform non-ESOP owned companies. And we've seen that happen throughout the recession, throughout COVID. There are some true tangible benefits to having employees engaged in the companies where they work. So let's talk about benefits to the owner. One is that they can continue to manage the company. They can continue to receive reasonable compensation while they're performing services for the business. They can participate in the ESOP unless they elect Section 1042. And they also have the ability to work on the transition while they select and mentor the next generation of management. From a tax perspective, the ESOP transaction is treated as a stock sale, which can have some advantages if you were comparing it to a transaction where the buyer wants to buy assets to be able to take additional depreciation. The ESOP trust is a tax-exempt entity, so it's not looking for that step up in basis and those tax deductions. There's also the potential to take advantage of Section 1042 gain deferral. We'll talk about that in just a moment. And to the extent that the transaction is financed all or in part by the sellers, there's the ability to take installment treatment, which can provide a nice deferral of that gain. And then last but not least, depending on the financing structure, that seller, if they're taking back seller notes, they may be able to obtain a warrant to achieve some appreciation in the upside of that value of the company over time. So this is going to take us to our very first polling question. Which of the following is a benefit to the owner in an ESOP transaction? Can continue to receive reasonable compensation, can participate in the ESOP unless using Section 1042, can select and mentor the next generation management team, or all of the above. And we'll give you guys just a few minutes to think about some of those benefits that we just talked about, and we'll see where our replies come back. It is pretty common when we talk to owners about the possibility of an ESOP that they're not necessarily ready to step away from the business on day one. It's very common that they may want to have a transition period where they are working on getting their successors in place. And so it's important that those owners, as they continue to work on making the ESOP successful, that they're being compensated fairly. Okay, so 81% of you said all of the above. Excellent work, and those are all key reasons why an ESOP might be a good fit. One of the other primary questions that we receive a lot when owners are thinking about an ESOP transaction is, well, what value can the ESOP pay? And there can be a lot of misconceptions around ESOP valuation. One of the biggest misconceptions is that you might have to sell at a discount to implement an ESOP transaction. The reality is that the rules just say that the ESOP can't pay more than fair market value. The thing to remember is that the ESOP is a financial buyer, and so they are buying the company as it's operating currently. It's a little different than a strategic buyer where you might come in and hope to achieve some synergies by putting two companies together. So sometimes there can be a difference between what a strategic buyer might pay because they're hoping to achieve those synergies and what a financial buyer might pay. But an ESOP is very comparable from a financial buyer perspective. And so what happens is that the ESOP trustee will have their own independent valuation advisor, and the sellers will never see that valuation report. And many times the company will have their own independent valuation advisor to help advise and coach them on what sort of value might be reasonable in an ESOP transaction. And there will be an arm's length negotiation around what the price looks like, as well as the other key terms in those transactions. So let's talk for a moment about Section 1042 gain deferral. Section 1042 gain deferral is a component of the tax code that effectively allows a seller, if they do certain things, to be able to reinvest their proceeds in other assets and to defer that gain. The idea is that if you defer that gain until the date that you die, under the current tax law, you would get a step up in basis, and that tax deferral would go to a permanent avoidance of that gain. The requirements for Section 1042 is that the stock must have been held for 3 years. The company must be a C corporation on the date of sale. the ESOP must own 30% or more of the company after the sale transaction, and then those proceeds must be reinvested in qualified replacement property within 12 months of the date of sale. You don't have to elect Section 1042 on the total proceeds. And one interesting development was under Section or Secure 2.0, S corporations will have the ability to elect Section 1042 on 10% of their gain, but this isn't effective until sales that occur after December 31, 2027. So qualified replacement property is effectively stocks or bonds of domestic operating companies. And that QRP receives the carryover basis from the original stock that was sold in the ESOP transaction. At any point in time, if that QRP is sold, it does trigger the underlying income tax on that original sale transaction. The idea behind that is that when you are buying that QRP, you can also often purchase what are called ESOP bonds or ESOP floating rate notes, where effectively you can margin up to 90% of what you would need to effectuate that reinvestment. And so you have a yield on the bonds and you have a cost of those margin loans, and there's an arbitrage cost of holding that investment. We're not seeing a ton of Section 1042 in the current income tax environment, but it's always something to consider, and especially in companies that are already C corporations, or when you have a situation where you may be in a really high tax rate state, for example, like California. So I'm going to turn this over to Angela Fisher to talk about benefits to the company.
So another major stakeholder in an ESOP transaction is going to be the company, and what sort of benefits the company is going to see from an ESOP transaction. And one of those is going to be its ability to repay the acquisition debt with pre-tax dollars. And what's happening is every year contributions are made to the ESOP to fund the debt of the transaction. And when those contributions are made, they're considered tax deductible employer retirement plan contributions. So you're essentially able to deduct both the principal and the interest on those payments. If you're a company that's currently taxed as a C corporation, this can be pretty helpful to get that additional deduction. The biggest benefit, I would say, though, is for a company that is taxed as an S corporation, because 100% ESOP-owned S corporations are exempt from federal and most state income tax, because the ESOP we talked about before is a qualified retirement plan. And back in 1998, the rules changed that allowed ESOPs to be what are considered qualified S corporation shareholders. So all of the earnings of the company, if you're a 100% S ESOP, all of the earnings are attributable to the ESOP, which is this qualified retirement plan, and therefore it is tax exempt. Right now, the highest federal income tax rate is 37%. So that's a pretty significant cash savings. Most states, like I mentioned before, do follow this flow-through status of the federal. However, there are some states that do not, such as Tennessee or Mississippi or Texas, for example. And then lastly, whenever we speak with our ESOP-owned companies, they talk about all of the benefits that they see that are long-term in nature. Kara talked about it before, that ESOP-owned companies outperform non-ESOP-owned companies. And it's really because you see this more productive, more engaged workforce, because employees are now focused on improving performance of the company, because it's in turn creating a bigger retirement benefit for them. But of course, you can't just, become an ESOP and think that's all you need to do. It's really those ESOP-owned companies that do a lot of communication are the ones that are seeing all of the value that their participants are bringing. So we're going to move on to polling question number 2. When an ESOP borrows money to purchase stock, this is referred to as what? A management buyout, a leveraged ESOP, a non-leveraged ESOP, or I don't know. And here in a little bit, we'll talk more about kind of the nuances of a leveraged ESOP and how it may differ between, a leveraged ESOP versus a management buyout, and where you tend to see pros and cons of those as well. And we don't necessarily talk about it in this presentation, but not all ESOPs have to be leveraged. You do tend to see some non-leveraged ESOPs. I know that we had webinars earlier this summer that talked more about some of those non-leveraged ESOPs. So go ahead and check out our homepage, and you can see those archived webinars as well. So I'll give you guys a few more seconds to respond. And the correct answer is B, a leveraged ESOP. So in general, what is happening is the ESOP, like we spoke before, is borrowing money to purchase the shares from those selling shareholders. And it's very similar to other traditional leveraged buyouts, where someone is borrowing money to purchase those shares. The difference, though, is that an ESOP can really do it in a tax-preferred way, right? We talked about those tax benefits that the company sees being exempt from federal and most state income tax. Another key difference is that those management buyouts tend to take longer to pay off than maybe an ESOP, again, because of the tax benefits. And then another key difference between an ESOP or a leveraged ESOP and maybe a management buyout is that with the ESOP, and we'll talk about this, is that you're spreading that wealth over a broad-based employee group, whereas a management buyout, that value tends to be concentrated. So there are really two types of leveraged ESOP. So you have a 100% leveraged ESOP, but then you also have a partial leveraged ESOP. So I'll start on this left side with a 100% ESOP. And this is really where you're getting the most out of your tax benefits because, like we mentioned, you're exempt from federal and most state income taxes as long as you are taxed as an S corporation and that ESOP owns 100%. And then we also touched on this briefly, but warrants are a way for those sellers to retain some upside in the company if they're financing a significant portion of that transaction. And then also in a 100% sale, there really is no need for future stock transactions just because the ESOP is perpetual in the ownership structure. So it's kind of like a one and done type transition. Now, it doesn't mean that you have to do a 100% transaction. You can also have a partial ESOP. In fact, you can really have any percentage of the company. However, whenever I get asked this question, I always caution a seller to think about, yes, you can do any percentage, but you really want to make sure that that percentage is significant enough compared to the costs of maintaining that ESOP. So you want to make sure that your participants are actually seeing value for how much it may cost to keep that ESOP going long-term in nature. But for any piece that the ESOP does own, again, you're getting that partial tax benefit and you're also able to deduct the principal on that ESOP loan. However, the downside of a partial ESOP transaction is the need for a second stage potential ESOP transaction. So you haven't fully transferred that all of the stock, and so you would need to do another transaction later down on the road. How a leveraged 100% ESOP works is there's going to be a lender, and that's going to be the top left of your slide. So that lender, it may be a combination of a bank and the selling stockholder, or it could just be the stockholder themselves. And those lenders are going to lend to the company directly. And they lend to the company directly because that's where all of the assets are held. It's the business and it's where the collateral is. So the lender is going to lend to the company, and the company is going to turn around and loan those funds to the ESOP plan. When the plan is initially set up, it's essentially an unfunded retirement benefit plan. It has no assets and it really has no way to borrow money on its own. So it looks to the company as its source of financing. And the ESOP then uses that money that it borrows from the company to buy the shares from those selling shareholders. And so that's how we get to the bottom right of this slide. So at the end of the day, how the repayment works is you're really going to have two sets of notes. And on the left side is what I like to call the real debt. It's the debt between the company and the lenders. So cash is actually leaving. And then on the right side is more of that internal loan that we'll talk about. So let's maybe start with the left side. for the left side of the slide. So the debt is going to pay off between the company and the sellers or the bank as quickly as it can based off of the cash flow that the company is generating off of the operations. Kara talked about the ESOP is a financial buyer. And so this is where it comes into play about the fair market value based off of how much cash the company is generating. And so this may pay off in monthly or quarterly payments over a set amortization schedule. And typically we see it being paid off over maybe a 7 to 10 year period of time. And it's really a function, if you're a 100% S ESOP that's used to paying out S distributions to your individual taxpayers to pay their taxes, and instead you're using those funds to pay down the debt of the transaction, and that's really how it's becoming more tax efficient and cash efficient for the company. Now, on the right side of the slide is what we call the internal loan, and it's the loan between the company and the plan. And I'm not going to spend too much time on it because we have a slide for it later on, but really the right side of the slide, that internal loan is going to pay off really depending on the size of the transaction and the level of eligible compensation the company may have. So right now we're generally seeing at least 30 years up to 40 or maybe even higher, but I'll talk about that internal loan here in a little bit. Company loan options. Another common question we hear is how much can the company borrow to fund this transaction? So maybe the seller doesn't want to fund all of it and they would like to get some cash up front. And if you think about traditional bank financing, normally what they are doing is looking at the collateral within the business, they're looking at the cash flow of the company, and really how comfortable they are with the management team. In terms of the level of bank financing that is available, it can really vary greatly depending on your specific company. For example, we have some clients that have a lot of hard assets like heavy equipment, cranes. They may have a lot of real estate. So it's easier for them to obtain third-party financing because they have those hard assets that can be used as collateral compared to maybe our professional services firms where they are more service-based in nature and primarily cash flow-based. Another important thing to consider whenever you're looking at bank financing is you also need to understand how much leverage your company already has. So if you've already leveraged up your AR, your inventory, your equipment, then there may not be a lot of room for additional bank financing. You also, if you're in the construction space, you also want to consider any bonding provisions or bonding covenants that may impact the amount of bank debt that you're able to get. So what we see is a good portion of our transactions are 100% seller financed. And it's really just at the preference of those sellers because they would rather keep the company not so leveraged with third parties and they're not used to maybe a lot of bank debt. And so they would rather just finance the whole thing themselves because any portion that is going to be financed with the bank, it is that bank debt is going to take precedence, which means that the seller notes are going to be subordinated to the debt or to the bank. And that seller debt, it tends to be friendlier in nature because those are friendly lenders. Your sellers tend to be more flexible so that if maybe the company experiences a decline in its cash flow, then there's the ability to delay those payments or maybe reduce them while the company attempts to recover. For interest rates that we see on that seller debt, because it is subordinated to the bank, it can range anywhere from 7% to 10%. But whenever we're setting those interest rates, the trustee is going to look at what's happening in the market. How is prime doing? Obviously, deals that were transacting in 2021 probably have a much lower interest rate than the ones now, simply because of the fluctuation in the markets. But it's really going to be a combination of cash pay interest and then also those warrants, because those warrants are meant to buy down that annual interest rate to make cash flowing it on that annual basis much easier, but then be paid out at the end once the debt has been repaid and bring that rate of return up to a more market rate. ESOP loan consideration. So this is really the mechanics of the right side of that slide that I talked about before, where the company is loaning cash to the ESOP in order to buy those shares. And so for 100% ESOPs, we typically see an amortization schedule of at least 30 years. I talked about it's at least 30 years, and we've also seen it, go up to 40 or 50 or even higher than that. And what happens is each year the company will make a contribution to the ESOP equal to whatever amount is determined on that amortization schedule. But remember that the ESOP also owes the company cash from the transaction. The ESOP will use that contribution to repay the ESOP loan, and that generally happens on the same day. So there's really no cash flow impact to the company because cash goes out, but it comes back in. And you are probably saying, Angela, why do I have to wire cash to the ESOP just for them to turn around and send it back to me? And I will say there's really two purposes. Number one, the contributions to the plan are tax deductible, and then whenever it goes back to the company, that is what's releasing shares into eligible participants' accounts. So how employees benefit. The ESOP is invested in company stock, so it's going to be its own company stock. The longer an employee stays and the more stock they are going to get. And then again, based on that internal ESOP loan, shares are going to be released annually. And then, Kara, I'm going to let you take over the third polling question.
Thanks, Angela. So, which of the following are company loan options? Traditional bank financing, seller financing, all the above, or I don't know? And we'll give everybody just a few moments to complete that poll. All right, so the vast majority of you said all of the above. That is excellent. And as Angela said, definitely lots of flexibility on how those ESOP transactions are financed, and they can very much be catered to whatever that individual seller is looking to achieve. So let's move right ahead and talk about ESOP plan design. So from a plan design perspective, we have a lot of overlap with rules that you might be familiar with around 401k plans or other types of qualified retirement plans. Eligible employees are generally allowed to participate, subject to restrictions around age and years of service. Typically, if an employee is at least age 21 and has been with the company for a year or longer, if they're working more than 1,000 hours in a year, we're required to let them participate in the plan. You could always make those requirements lower, so more generous to employees, but that would be the maximum. Shares are most of the time allocated based on eligible compensation. And so that would mean if I have two employees and one makes $30,000 a year and the other employee makes $60,000 a year, the $60,000 a year employee would have twice as many shares as the $30,000 a year employee. That is subject to IRS limitations on maximum compensation, which are indexed with inflation annually. Things that participants are required to see on an annual basis would be their own individual ESOP account statement. They're also required to receive a copy of the Form 5500 if they would like to have a copy, but we do not have a requirement to share the full financial statements of the company. Many companies may choose to share information, but it's not required that the company would disclose full financial statements and footnotes. From a plan design perspective, the two vesting schedules that are available are a 6-year graded, that's 0% year 1, 20% year 2, an additional 20% each year until year 6 when they are fully vested. The other option would be a 3-year cliff, so that employee is 0% vested for years 1 and 2, and 100% vested in year 3. And then the other important thing to think about is repurchase obligation. So when participants leave the company, if they're vested, they're required to receive their benefit in cash. And so generally if an employee leaves at retirement, death, or disability, we're required to begin paying them the year after they leave. But if they leave for any of those other reasons, then we can effectively make them wait until 5 years after they terminate, or to repayment of that internal loan that Angela was talking about, or we can make them wait till they hit normal retirement age if that comes first. And then once they start receiving their payments, we can pay them in installments over a 5-year period. Another thing that is very critical to having a successful ESOP is having a management team that's properly incentivized to help the company pay down debt, to grow, to retain employees. So as part of the ESOP structuring, many times we will take a look at the executive compensation packages. And that may be looking at salaries, looking at bonuses, thinking about potentially non-competes, depending on whether or not that non-compete language is legal in the state that you're operating in. It's also very common that we would look at a separate synthetic equity plan for the executive team in addition to the ESOP participation. Because ESOPs are qualified retirement plans, there are limits on how much any employee can accumulate in that plan. So many times we may put an incentive stock option plan or a stock appreciation rights plan as an additional type of compensation for that management team. Those executive incentives do need to be approved by the independent trustee to make sure that they are reasonable, number one, from an overall dilution and a fairness perspective, but also that they result in reasonable total compensation. So both those things are important factors to consider. One of the other topics that I get a ton of questions about is corporate governance. There is a strong misconception out there in the marketplace that if you sell to an ESOP, that the ESOP trustee is able to tell you how to run your business and that they have control over the management of the company. So even if the ESOP owns 100% of the company, they may have legal control of the company. And as part of that legal control, they would have the ability to vote the shares if there were a transaction that required a vote of the shareholders. They may have the ability to negotiate 1 or 2 independent members on that board of directors slate, but they never want to sit and be a part of your board. They also don't want to tell you how to make management decisions. It's really up to the board of directors to set the major policy and strategy for the company. And then ultimately it's up to the executives to execute that strategy. The trustee is going to have a couple major things that it does. Number one is it does elect the board of directors. It also sets the annual stock value for the ESOP participants. And if there were a major transaction, the trustee would need to be involved. If there were a sale transaction, the trustee would definitely need to be a part of that. And in certain situations, if the company were to sell substantially all the assets of the company, or if there were a transaction that required a pass-through vote under state law, in that case, participants would actually have to submit their votes to the trustee. And then the trustee would make the decision that was in the best interest of the participants. But for the most part, even the day after the transaction closes, it's pretty much business as usual. And the board and the company can go about doing those things that they need to do to run the company on a day-to-day basis. So from a transaction consulting perspective, Forvis is typically there to help design and facilitate that transaction. We do a lot of modeling to help companies figure out whether an ESOP could be a good fit, to talk about pros and cons and how it might work. We're there to assist with obtaining outside financing if that is something that the seller is interested in doing. We can prepare valuations on behalf of the sellers and assist with the negotiations in the transaction. There will also be separate ERISA counsel. Company needs its own counsel to help it with ESOP-related issues. And then ultimately, we would need an independent trustee who is there to negotiate the best deal they can on behalf of the participants, and that's their duty under ERISA. They're going to have their own counsel. They're going to have their own appraisal firm that will assist them through that negotiation process. And then ultimately, if a bank is involved, there would also be the bank and potentially their counsel as well. From a timeline perspective, normally my advice would be plan on that total process taking anywhere from 7 to 8 months to complete. And when you think about what some of those steps are, typically you're looking at initial feasibility analysis, initial valuation analysis. And if both of those things come back and the sellers are ready to move forward, from that point, you would ultimately begin interviewing trustees, interviewing ESOP counsel. And then once that trustee is involved and engaged, they would typically want 3 months to close that transaction. And that's important so that they can really demonstrate that they've had adequate time to do due diligence and to negotiate the best transaction that they can for those participants. So let's talk just for a moment about the current ESOP transaction environment. So we've got a few different things to think about right now. One would be the interest rate environment. We've seen the first of what we think will be numerous Fed decreases. And so as part of that, that has a couple of different implications. One is that from a valuation perspective, generally we need to make sure that we're taking into account that interest rate in the weighted average cost of capital. And so that has a positive impact on valuation. The other side of it is if you are looking to finance that transaction, having a lower rate can definitely make that more affordable. Whether that's you are going to the bank and looking for a term loan, or whether you are a seller and you are taking back subordinated debt, that means you potentially have a lower rate, which should make it easier for the company to be able to cash flow that transaction. When we think about industries right now where we're seeing a lot of activity, we continue to see a lot of activity in construction. I think over time, construction companies have recognized that ESOPs are a great way to reward and incentivize their employees. And especially in certain markets, ESOP has almost become, it's either a competitive advantage, or in some markets, if you don't have an ESOP, it can be seen as a bit of a detriment if all of your competitors in that space already have ESOPs in place. The other part that I'm seeing, which is a little bit unique, is in this environment where remote working is so much easier than it was before. So you do see, especially in professional services firms, where you might have employees all over the country, more of those professional services firms adding ESOP to their lineup of benefits. And now that they're not just competing for employees in their neighborhood or in their state, they're competing with competitors all across the country. It just means more and more of those professional services firms are at least considering adding ESOP to their lineup of their existing benefits. We are continuing to see clients wrestle with the impact of inflation. And so whether that's inflation on the products that they are bringing it in, if you're a manufacturer, on those inputs, or whether that's inflation of your labor, if you're a service environment. From an industry perspective, we have still continued to see manufacturing and distribution transactions slower than they were before COVID, whereas we're seeing lots of activity on the service-based and on construction. So hopefully, as inflation has come down, we'll see performance in those companies really start to level out and hopefully see some of those transactions start picking back up. Other things to think about too would be just the overall political and economic climate. And so we are coming into election season and looking ahead to what might happen in tax law, tax reform. I think one of the good things that we've seen over time is that ESOPs continue to have bipartisan support, which is amazing because ESOPs are one of the few particular topics where we get support from Republicans, because ESOPs are very pro-business owner. We're able to keep companies located there in their home districts. but then also see a lot of support for ESOPs on the Democratic side, which is wonderful because it really allows these companies to share the wealth, to benefit broad base of employees, and ultimately to create sustainable retirement plans. And so regardless of what happens in the election tomorrow, we think that ESOPs will still be very well suited, regardless of what may or may not happen. Other big things to think about, like going on right now, we have Secure 2.0, which ultimately required Congress to issue fair value regulations. So ESOPs were put in place back in the 1970s. And as part of those regulations, there was the need to implement fair value regulations. And 50 years later, we still don't have them. But the latest development is that Department of Labor has drafted the very first draft of those regulations, and ultimately it is beginning the approval process. So we are waiting all very eagerly to see what the first draft of those regulations may look like. Although the reality is that it may be some period of time before those regulations are ultimately approved. And there's still some uncertainty as to whether when we have a new president, if that president will want to try to change or impact some of those regulations. So we're at a point where we're just going to wait and see what happens. There are lots of things moving at the moment. So what are some of the reasons why you might not want to do an ESOP? Well, the reality is that while ESOPs are wonderful, they're clearly not for everybody. And so part of the things that we have to think about is that even though an ESOP can pay fair market value, there might be a strategic buyer out there who could potentially pay a higher price. And it goes back to what we talked about earlier around synergies. If I have two companies, 2 plus 2 might be 5 or 6 rather than just 4. When we do an ESOP transaction, one of the benefits from an owner's perspective is that there aren't often big changes. We're not putting in a new sign. We're not laying off departments where there's duplicated departments in this combined company. But because we're not receiving those synergies, we may not be able to achieve the same price that a strategic might be able to pay. But I think it's important, no matter what industry that you're in, that you're really evaluating what the prices might be under those two different models. And so oftentimes we will work together with our corporate finance team to talk about how those prices might be different, and also to compare how the tax implications might ultimately impact the after-tax proceeds from those transactions. The other side of it too is thinking about the cash at closing. As we mentioned before, as Angela noted, many ESOPs are at least partially seller financed. Some of them are all seller financed. Most ESOP companies could get some level of bank financing unless they're already highly leveraged. But that might be different if you were comparing it to a third-party sale, where they might be willing to put more cash down and invest some of their own cash in that transaction. Other things to think about too, and we touched on Department of Labor regulations. That can be a drawback, right, to deal with another government regulator. Both the Department of Labor and the IRS have the right to investigate a transaction after it closes, and they could have the ability to claim that the ESOP paid more than fair market value. And if that happens, that ESOP transaction would be considered a prohibited transaction. So it's very, very important when you are going through that ESOP transaction process to make sure that you are using a good team of advisors, that you're carefully evaluating the purchase price, going through a solid valuation process to help make sure that that transaction would hold up to any scrutiny if it were ever to be pulled for audit. So what are some other things to think about when you are considering an ESOP transaction? So some of the considerations would be thinking about your overall estate tax plan. Think about any desires that you may have for charitable giving or wealth planning. It is very common that people undertake an ESOP because they are trying to think about, how do I plan for the next generation? Do I want to make some gifts? Am I going to have an estate tax burden? If I were to die unexpectedly, does my estate have enough cash to be able to pay any of the estate taxes that are due? And so an ESOP could be a very important part of that plan to gain some liquidity prior to an estate tax event. The other thing that we're seeing a lot of is estate planning and wealth planning through warrants. So we talked about warrants very briefly, but basically a warrant is like a stock option that gives a seller holding a note the right to a certain percentage of the company's value at a time in the future when that debt is repaid. And when a warrant is issued, it is generally issued at the current value, which is after debt. So the value of that warrant is low, and you have the ability, if as the seller, if you don't need that warrant to fund your lifestyle, then you may decide to gift that warrant to your children, to a trust, to grandchildren, to get some of that value out of your estate at a really low valuation. So definitely seeing a lot of that, especially in light of potential upcoming changes to the estate tax rules as those rules sunset next year. So we'll be watching that very, very closely as well. Other things to think about would be, Angela talked about the benefit of S corporation ESOPs. And certainly those tax benefits can be tremendous, but there are also rules that govern those benefits under what's called Section 409P. And Section 409P is really intended to make sure that if an S ESOP is going to receive that tremendous tax benefit, that benefit is not concentrated amongst either a small group of executives or a group of family members. So when I think about companies who have smaller employee groups, if you have less than, let's call it 30 employees, we may want to do some pro forma testing around Section 409P to make sure that we are not going to have a compliance issue, because 409P is intended to be catastrophic if you break the rules. So it's very, very important to plan for that well in advance. Other things that we see as we think about a potential ESOP transaction would be key man life insurance. So if you have an existing policy, or if you're thinking about taking a policy, that can be helpful, especially if there is a large amount of seller notes that are outstanding. And then last but not least, thinking about how do we manage fiduciary risk. So whether that's making sure we have sufficient insurance for the board, for our trustee, and also the use of that independent institutional trustee. All of those things are things that work together as we think about putting together a strong transaction. So we have made it to polling question number 4. And if you would like to schedule time to talk about any of these topics, just feel free to click your poll, and we will be very happy to follow up with you after the webinar. And so last but not least, when might an ESOP be right? And so, as we think about our practice is not to sell as many ESOPs as we can. It's to make sure that we are putting in place good ESOPs that are going to be successful for the owners, for the employees, and for their communities. And so some of the factors that we see when an ESOP turns out to be a good option is if it's important for that owner to preserve legacy and culture, but they're also thinking about retirement. We're also looking for owners who are willing to carry some of that financial risk through a seller note for a period of time. You probably don't need to stay there forever, but it can certainly be helpful if that owner would be willing to stay on 3 to 4 years to be able to get that ESOP off to a good start. And then from a financial perspective, some of the metrics that we would suggest would be an equity value of $5 million or more, and potentially 30 or more employees. Neither of those are hard and fast rules. As Angela mentioned in her slide, you can really do an ESOP at any level, but I also think it's important to be practical because it does cost some to get the ESOP up and going, and there are costs of maintaining that plan. It also does create a level of complexity in terms of the administration and the financial reporting. So ultimately, we are looking for really companies that are profitable, that have stable cash flow, and hopefully that have benefits for significant corporate income tax savings. And with that, I think we may have a few moments for questions. Holly?
Hi, yes, we have several questions. The first one is there any minimum number of employees that need to exist for a company to be a valid ESOP candidate?
That is a great question, Holly. And so from a legal perspective, there is not a minimum number of employees, but as we talked about before, there are rules for S corporation ESOPs under Section 409P that are very hard to comply with if you have a small number of employees. And normally my rule of thumb on that is 20 to 25 starts to be a little challenging. It doesn't mean it's impossible, but what it does mean is that you would want to do some pro forma testing if you are wanting to be an S corporation ESOP, and most of our clients want to be S ESOPs because of the tax benefits that come with that. Now, if you're going to be a C corporation ESOP, you do not have those same concerns around 409P. So it would be possible to do in a smaller number. But I think it's like anything, it's always facts and circumstance, the benefit that you're receiving from that ESOP relative to the complexity that you might be creating through implementation of that ESOP structure.
Great. We have another question. How long is the typical seller financed loan?
So that's another really good question where the answer is it can vary. So if you think about your ESOP valuation, it's normally a function of cash flow. And so what we're trying to do is line up the cash flow of the company so that we have an amortization schedule on that seller note where it's comfortable for the company to repay it. And in some scenarios, that might be as soon as 6 or 7 years, depending on what those valuation multiples look like. But we also have some companies, especially companies that are, for example, heavy on assets. Angela mentioned heavy contractors that may have a very high fair market value of their balance sheet, but have sort of a longer period of time to achieve those returns. So in those scenarios, you might even have a 10 or 12-year amortization schedule on that note. I think the takeaway is that it can be very different from company to company, but the overall most important goal would be is that you're setting your ESOP up for success so that you can withstand a little bump or two in your financial performance and still be able to pay off that note within a reasonable period of time.
Great. How do your client ESOPs generally handle voting rights for the shares held by the plan?
So most of our ESOP companies will only allow participants to vote in scenarios where it is required by law under their particular state. And so the laws from state to state are not always exactly the same, but as a general rule, you are required for participants to have a pass-through vote if it's a sale of substantially all of the assets of the company, or if it is a merger that requires a pass-through vote under state law. And in most all circumstances, if it's not one of those two situations, the trustee is then going to vote those shares on behalf of their participants. There are a handful of older ESOPs out there, and if there are any on the call today, we know that everybody does things a little bit different. And so there are a handful of ESOPs out there that may allow participants to vote on other things. For example, they might be permitted to vote on the board of directors. There are still a few ESOPs out there that do that, and that's perfectly okay too. You can provide more rights to those participants if you want to, as long as you're at least providing the rights required under the law.
Great. Do we have, I think we maybe have time for one more quick one, but I know you talked about the certain industries that are more conducive to ESOPs. And you mentioned, I guess, construction, manufacturing, and professional services. So I believe then we covered that question. Is that correct?
That's right. And you may also see them in distribution. There are a number of ESOPs in financial institutions. Many of those are very small minority ESOPs that maybe were put in place back through some of the savings and loan restructuring. So certainly lots of bank ESOPs out there, but those tend to function a little bit differently than the 100% of the majority ESOPs that we're talking about here. You know, you sometimes see ESOPs in healthcare. There can be lots of different places. And definitely, if you think an ESOP is something that's interested, if you're not in one of those industries, don't assume that it doesn't work. It just may not be, it's not as common. So reach out and we can help with any specific questions. And I think that about wraps us up, Holly.
Yes, thank you very much.